IFRS 18 is not just a new name for IAS 1. For SBR, it changes how students must think about presentation, subtotals, operating profit, management performance measures, and even the statement of cash flows. The standard was issued in April 2024. It replaces IAS 1 and it is examinable in SBR from September 2025 onwards. This video is your fast revision guide. By the end, you should know what changed, where items go, and how the examiner may test it. IFRS 18 is mainly about presentation and disclosure. It does not rewrite recognition and measurement for every standard. Instead, it asks a different question. Once the income, expense, asset, liability, equity, or cash flow is recognized, how should it be presented so users get a useful structured summary? That phrase matters. Useful structured summary. The examiner can test whether a draft statement is organized clearly, whether categories are correct, whether mandatory subtotals are missing, and whether vague labels hide useful information. So think of IFRS 18 as the standard that brings discipline to how financial performance is displayed. Start with the statement of profit or loss. IFRS 18 requires income and expenses to be classified into 5 categories: operating, investing, financing, income taxes, and discontinued operations. Operating is the default category. If an item is not classified in investing, financing, income taxes, or discontinued operations, it goes into operating. Income taxes are tax income and expenses under IAS 12. Discontinued operations are income and expenses from operations that meet the IFRS 5 definition. The real exam work is usually deciding between operating, investing, and financing. The investing category is for income and expenses from assets that generate returns individually and largely independently of the entity's other resources. Think of investments in associates, joint ventures, unconsolidated subsidiaries, cash and cash equivalents, debt investments, equity investments, and investment properties. Typical investing items include interest income, dividend income, rental income from investment property, depreciation on investment property measured using the cost model, and gains or losses on disposal of investment property. But there is an important SBR warning. If investing in a particular type of asset is a main business activity, some items that look investing may move to operating. For example, if a property investment business has investment properties as a main business activity, income and expenses from those properties are operating. However, income and expenses from equity accounted associates are always investing. The financing category is about income and expenses from liabilities used to raise finance. This includes bank loans, loan notes, debentures, and similar funding liabilities. Interest expense, fair value gains or losses on relevant financial liabilities, and dividends on shares classified as liabilities can be financing items. But some liabilities do more than raise finance. Lease liabilities, contract liabilities, decommissioning provisions, and defined benefit pension liabilities are examples. For these, only the interest income or interest expense, including unwinding of discounting, goes to financing. Other income and expenses usually remain in operating. For a defined benefit pension plan, service cost is operating, but net interest is financing. That is exactly the kind of extra detail SBR now expects. Foreign exchange differences follow the item that created them. A foreign exchange gain or loss on a trade receivable is operating. A foreign exchange gain or loss on a loan liability is financing. Derivatives use a similar logic when they manage an identified risk. If a futures contract manages the risk of buying inventory, gains and losses reported in profit or loss are operating because inventory purchases relate to operating activity. This is true whether or not hedge accounting is applied. If a derivative is not used to manage an identified risk, gains and losses are usually operating, subject to exceptions. The shortcut is follow the underlying exposure. Main business activity is one of the biggest IFRS 18 exam traps. The question may tell you that the entity invests in particular assets as a main business activity or provides financing to customers as a main business activity. If so, some income and expenses that would normally be investing or financing become operating. A bank that provides finance to customers reports interest income from customer loans as operating. If the bank borrows money to provide that finance, the related borrowing costs may also be operating. But if a normal manufacturing entity simply earns interest on spare cash, that interest income is investing. In the exam, do not assume. Use the facts given. If the scenario says the activity is not a main business activity, respect that. IFRS 18 makes certain subtotals mandatory in the statement of profit or loss. Operating profit or loss. Profit or loss before financing and income taxes. And profit or loss. These subtotals must be presented even if two of them show the same figure. Gross profit and profit before income taxes are not mandatory under IFRS 18, although many entities will still present them if they help create a useful structured summary. For SBR, this matters because a question may ask you to review a draft statement. You may need to spot missing mandatory subtotals, wrong subtotals, or items placed in the wrong category. IFRS 18 also pushes candidates to think about line items. Expenses can be presented by function, by nature, or by both, depending on which method gives the most useful structured summary. If an entity mixes nature and function, the line items must be labeled clearly. For example, a line could say depreciation costs other than those included in cost of sales. That is much clearer than a vague label. IFRS 18 is also cautious about the word other income, other expenses, or miscellaneous items usually do not tell users what is inside. If a better label is available, use it. If not, describe the aggregated items as accurately as possible, such as other investing income. Aggregation means combining items with shared characteristics. Disaggregation means separating items with different characteristics. The goal is not more detail for the sake of more detail. The goal is useful information. For example, HR, IT, legal, and accounting costs may share enough characteristics to be grouped as administrative expenses. But a goodwill impairment does not share the same characteristics as routine administrative costs. Hiding it inside administrative expenses would usually be inappropriate. In SBR, you may be asked whether the level of aggregation or disaggregation proposed by management complies with IFRS 18. Your answer should explain whether the line item helps or hides understanding. This is the area students often mix up, so separate two ideas. First, APM. APM means Alternative Performance Measure. It is a broad term for a financial measure that is not specified or defined by IFRS accounting standards but is used by management to explain performance or position. Examples could include adjusted profit, adjusted EBITDA, free cash flow, net debt, or constant currency revenue. APM is the broad family. MPM is the narrower IFRS 18 category inside that family. A management defined performance measure or MPM is a subtotal of income and expenses. It must be used in public communications outside the financial statements. It must communicate management's view of an aspect of the financial performance of the entity as a whole. And it must not be a subtotal specifically required by IFRS accounting standards. So the test is 4 steps. 1. Is it a subtotal? 2. Is it made up of income and expenses? 3. Is it used outside the financial statements, for example, in a press release, annual report commentary, or investor presentation? 4. Does it show management's view of the entity's financial performance as a whole? If the answer is yes, it may be an MPM. Adjusted operating profit, adjusted profit before tax, or operating profit before restructuring costs can be MPMs if management uses them publicly. Free cash flow is not an MPM because it is not a subtotal of income and expenses. Net debt is not an MPM either because it is a statement of financial position style measure, not a profit or loss subtotal. Revenue growth is also not normally an MPM because it is not a subtotal of income and expenses. If a measure qualifies as an MPM, IFRS 18 requires disclosures in a single note. That note must explain what the measure communicates. It must explain why management thinks the measure is useful. It must show how the measure is calculated. It must reconcile the MPM to the most directly comparable IFRS subtotal. And it must show the income tax and non-controlling interest effects of each reconciling item. In an SBR answer, do not just say disclose the MPM. Say what the note must contain and use the measure from the scenario. IFRS 18 also caused changes to IAS 7. Under the indirect method, the operating cash flow reconciliation now starts with operating profit. It no longer starts with profit before tax. IAS 7 also uses the label cash from operating activities before income taxes, rather than cash generated from operations. There is another important point. Adjustments for non-cash items are only made in the reconciliation if those items are included in operating profit. So depreciation on investment property, share of profit from associates, or gains and losses on financial instruments may not be adjusted if they sit outside operating profit. Dividends paid are financing cash flows. For most entities, interest paid is financing, and interest and dividends received are investing. Here is how IFRS 18 can appear in SBR. Question 1 may include a pre-populated spreadsheet with draft financial statements. You may need to correct presentation errors. For example, moving interest paid from operating cash flows to financing cash flows. You may need to insert a missing operating profit subtotal. You may need to reclassify pension net interest from operating to financing. You may need to challenge a vague line called other expenses, or you may need to decide whether adjusted profit is an MPM and explain the disclosure note required. This is not just theory. It can become marks in both calculations and narrative explanations. When you see IFRS 18 in SBR, use this checklist. First, identify the statement, profit or loss, cash flows, or notes. Second, classify the item, operating, investing, financing, tax, or discontinued. Third, check the main business activity facts. Fourth, check whether mandatory subtotals are present. Fifth, challenge vague labels and poor aggregation. Sixth, identify whether a measure is an MPM and if it is, require the IFRS 18 note. Seventh, for cash flows, start with operating profit and classify interest and dividends correctly. This is the fastest way to turn IFRS 18 into marks. The core message is simple. IFRS 18 is about clarity. It makes profit or loss more structured, subtotals more consistent, management measures more transparent, and cash flow presentation more disciplined. In the exam, do not only say where the item goes, explain why it goes there. Category, subtotal, label, disclosure. That is your IFRS 18 revision map.